Hi everyone, this is Yongka here, the US equities analyst. So today I'll just be quickly getting you through the US oil and gas. So I'll just highlight 5 key facts on the crude oil itself. Okay, right. So okay, firstly I'll just highlight, okay, this global oil demand supply. And then this is a chart that we pulled off from IEA. So it showed that actually the going forward to first and second quarter 2015, we're actually looking at an oversupply partly because of weak demand as well. There's a slower economic recovery, stronger USD. So the 3 regional countries, Malaysia, India, Indonesia, have cut oil subsidies. Not only that, but of course, we know that US have been the shale oil has actually been increasing production year over year. So going forward, if demand picks up after first half 2015, that could moderate the oversupply situation. But right now, what we see is that there is about 2 million barrels of surplus. Okay, oil stock is actually 2.7 billion barrels in October 2014. So this is above a 5-year average as demarcated by the blue dotted line. It's also above the 2013 levels, and additional surplus. What we see is that for the first half 2015, the oversupply could actually equate to about 300 million barrels. So this could push it above the 5-year high, right? And this might exert downward pressure because you run out of storage space and you just have to let go of your 5-year sale price. Then again, back in 2009, when the oil price is in contango, traders actually they could store oil for profiting later. This move is counter-cyclical and also helps to absorb excess supply. What is contango? Again, just a brief recap for those who are not too familiar. Contango is actually refers to the slope where future dated commodity is more expensive than today's. So what traders can do is to just store the oil today, and then they will sell the future for say December 2015, and by doing so, they can actually earn a 12.8% gross margin over 10 months. But of course, you have to deduct storage and insurance costs. In this way, actually in 2009, 100 million barrels of oil was stored in offshore tankers, and this helped to absorb some of the surplus that would have instead flooded market. Another point we want to point out is that actually the 2015 deliveries, right, actually they are most actively traded, but even you sum up all of them at 1.4 billion barrels in total, this represents only less than 16 days worth of supply. So this actually is not very representative of the physical market. Okay, this is Cushing, Oklahoma, US the WTI oil grade. Actually, adjusted similarly is actually down 20% year over year, even though you see the slight spike towards the end of 2014, but that's actually because the refineries often shut for maintenance during this quarter. We actually see this as a leading indicator because when it trades at the all-time high, WTI was traded at a $23 per barrel discount to Brent. Okay, just hold on. Okay, for those who can hear me, can you just maybe type it out in a question bank? Thanks. All right. Okay. So just resuming. So this is actually a leading indicator. If you look at the 2013, when it hit the all-time high in 2013, WTI traded $23 per barrel discount to Brent. Today it's only at $2+ per barrel. So whether it diverges or converges, it will actually be quite dependent on these crude stocks like Cushing, Oklahoma. Supply glut. Most of the time you read in the media is there's an oversupply because OPEC refuses to cut supply. Is that true? Let's look at this chart. Okay, what this chart actually tells you is that OPEC production has been more or less maintained at 30 million barrels per day in the last few years, whereas yet at the same time, world supply has been increasing. This increase actually, you look at the following chart, graph 5.1, you see that actually OECD America is the one that is responsible for the supply growth. Okay, OECD America refers to Mexico, Canada, and US. Okay, US primarily is the one contributing to this production growth. So what this means is that actually the US and not OPEC should be shouldering the responsibility for today's surplus. Again, you look at the following chart below. The US production actually has grown from just slightly less than 10 million barrels per day. It's projected to grow about 14 million barrels per day in fourth quarter 2015. So this itself is driving all the oversupply, not OPEC, which has actually stabilized its production at 30 million barrels per day. Okay, most of you might have seen this chart before. So again, what this means, these are prices all in break-even, so includes exploration, royalties, production, etc. Okay, at today's oil price, this crude oil is actually priced about, for WTI is actually priced at $47.70. This means that Arctic, oil sands, North American shale, ultra deep water, and even deep water is unprofitable, is below break-even. The immediate implication is that oil exploration for uneconomical geologies will be suspended. So again, we mentioned those that's above $50+ per barrel will be suspended. But yet, contrary to expectations, 2015 production guidance is not coming down. Of the 11 US shale producers we sampled, each with more than 20,000 barrels oil equivalent per day production that have announced capex cuts, only 2 projected flat output, and the rest about 5 to 43% growth. Even IEA itself also projected 1.3 million barrels per day increase due to non-OPEC outputs. Why? Okay, just look at the chart below, the graph. Actually, $2009, right? In 2009 cost, US, the lifting cost for onshore and offshore is only about $10+ per barrel. So that means that if you put aside the finding exploration costs, most of the production should still be break-even based on the 2009 prices. So because production cost is the variable one and exploration cost is fixed cost, is usually disregarded. Okay, moving on. So we mentioned that deep water is very unprofitable at about $52, $56, but it's still ongoing. Why? So this excerpt from the OPEC monthly oil market report December 2014. Deep water projects usually have a long timeline averaging 4 years. So because of this long gestation period, these projects are not sensitive to short-term price pullbacks. Just to illustrate, Jack and Malo, this oil field cost $8 million to develop, 30+ years lifespan. Total production that's planned will be about 500 million barrels or more, and also estimated cash cost is only $20 per barrel. Incremental investments to boost production is justifiable at $30 to $35. So that means that even at today's oil price, they can still justify boosting investments to increase production. Okay, something that's interesting and maybe not as what usually highlighted is that Canadian oil sands. So oil sands, just a quick recap, is essentially a combination of clay, sand, bitumens. Okay, it takes about 2 tons of oil sands to produce 1 barrel of oil. So this production typically is about, in 2013 is about 2 million barrels per day, and actually new projects are still slated to come online. So this year another 266,000 barrels per day of supply is will be coming on stream. The crude oil grade that's extracted from these oil sands, which is also otherwise known as WCS, is actually priced at a discount to WTI. The latest discount is $14 per barrel, so which means that it's actually will be sold in the market for $34 per barrel. This means that any $1 increase or decrease in price will be magnified on WCS. Bottom line is that it's more vulnerable to price declines, and let's say if WTI drops by another $15, you'll be looking at maybe WCS will only be priced at $20 per barrel, and at $20 it might be bordering uneconomical, and there's likely to be the production cut first. US tight oil, otherwise known as shale oil. So this is production has made up more than 25% of overall US output today. It's actually increased at a 47% compounded rate since 2009. As we earlier mentioned, of the 11 sampled producers, nearly all expect to increase production because and the focus is mostly on the higher value tight oil. Because even at today's depressed prices, 1 barrel oil is still worth 3 times that of 1 barrel oil equivalent of natural gas. It's also cheaper and faster to drill typical shale oil well, okay, compared to a conventional place. So the sunk cost is lower, but that means it's also more susceptible to short-term prices. Okay, this might be one of the most important charts of this presentation. So if you look at this chart, tight oil production actually declines by 80% by the third year versus only 25% for conventional wells. What's the implication? This means that they have to drill aggressively just to maintain flat production. Okay, but yet at the same time, they are planning a capex cutback in 2015, which will idle about 200 US oil drilling rigs, which is 30% of the total number out there. So what happens is that this reduction in exploration activity will limit the replenishing of new tubular wells. You're going to cut it into the productive acreages, and eventually, in 1 to 2 years' time, we expect it to halt production growth. Geopolitical risks. Okay, so we're looking at, these are mainly the major players. US is obviously the biggest player right now, the biggest producer. You factor in the natural gas liquids. Russia, Iraq, Venezuela, Nigeria, and Libya, the 5 countries in red. These are actually, in total, they contribute about 20% of world global supply. Okay, so we think that geopolitical risk right now might be underpriced, and if there's a more ISIS, or let's say last week when Libya tanker was bombed, or even Russia, if the currency destabilizes again, then the oil supply is expected to be disrupted. So just to summarize, right, to give a very balanced overview of the bull and bear points. Okay, bullish view, we have contango trade, where traders will store oil today for future sale at a higher price. So this is counter-cyclical and temporarily absorbs surplus stocks. You also have a leading indicator, pushing the Oklahoma WTI crude stocks right now is down 22% year over year. Okay, and you have to track it closely to see whether the discount will diverge or converge based on rising stocks. Western Canadian Select oil sands production currently sells for $34 per barrel, and this is about half of Canadian outputs. And so this is very vulnerable to future further oil declines. Tight oil production will decline by 80% by third year, according to the previous chart. So the producers need to drill very aggressively, and yet right now they're cutting back on capex. So this means that less production means fewer new drillable wells, and then you eventually halt or reverse tight oil production growth. Lastly, you have geopolitical risk, which we think that is underpriced today. Okay, so this 20% worldwide share of production might be at risk. Bearish view, even with all this in mind, in the near term, by second quarter 2015, we are expecting a 2 million barrels per day of global oil surplus amidst weak demand. Oil stocks is above 5-year average and also above 2013 levels. Production guidance is still higher. It hasn't adjusted yet. Most of the shale producers that we've sampled plans 5 to 43% production growth, and IEA forecasts increased from non-OPEC output as well. Deepwater projects, of course, they are not insensitive to short-term price pullbacks. So the fact that they might still consider investing at $30 to $35 per barrel means that in the near term you might not have a production decrease. So some quick takeaways, right? We're looking at $50 per barrel price right now. Seems unsustainable. Yet a lot of these producers have they have actually forecasted increased production. This is a paradox. Okay, firstly, it's cheaper the faster ramp up. So because they previously have done a lot of exploration, they have no lack of productive wells to drill in. Also, many have issued high-yield bonds to finance capex. So in the near term, they need all this cash flow to service the debt. Notwithstanding that, the production declines 80% by third year. Deepwater projects also have long gestation periods, so they are less sensitive to short-term price pullbacks after multi-billion dollars of sunk costs. OPEC, they see no need to come back because they are not contributing to the oversupply. Okay, contrast this to the back in the 08-09 where OPEC actually announced production cuts. Because back then production growth was flat, so by cutting back, you're actually cutting the oversupply right away. Whereas in this case, even if OPEC cuts outputs, you still have US, non-OPEC, that's ramping up their shale oil production. Lastly, the crude oil futures market is relatively small, so the total contracts for the full year delivery is only less than 16 days worth of supply. So it's not exactly representative of a physical demand supply. And another thing to consider when you're buying shares of oil-related companies, right? This is something that actually is not very often brought up, but you can actually infer from bond prices, fixed income, maybe either bonds or preferred stock, to see the equity is risky and not worth anything. So just look at the left chart, the share price. Actually, the company in less than half a year has actually dropped from $30 peak to about 370 today. But yet, if you look at the right charts, you see that the bond price is trading at 45 cents a dollar. So if the bonds is so trading at such a distressed price, the equity might be at risk as well. Secondly, don't rely on high dividend yields to support share price. So you look at this Crude owner. Previously, for 3 quarters, it actually paid out dividends. Annualizing will be about $1 until its November decision to suspend. So right after that, the share price has since fallen another 55% from 317. Okay, so you can see that high dividend yields are actually the most susceptible to be eliminated if it's not sustainable. So these are some of the stocks that are under our coverage. Currently, Keppel, Sembcorp, Ezion, as well is change of analyst, but we're looking at mostly reduced, neutral, that kind of ratings. Whereas for Kim Heng, we still have a buy, Triads a buy as well. Okay, so based on what the bond price theory that we discussed just now, these are some of the distressed US oil and gas producers that you might want to be more aware of. Okay, their yield to maturity for the bonds are actually more than 15%. Of course, this means that the equity is trading more like an option now. If the company goes bankrupt, then the option will go worthless. But if they can somehow make a nice recovery, then this option might be worth multiple times. And in fact, some of the companies have really dropped by 90%, such as Resolute Energy. So this will be a very speculative place if you do decide to invest in their shares. Whereas these are the top 10 largest NYSE listed oil and gas producers. We have Exxon, PetroChina, Shell, Chevron, Sinopec, Total, BP, ConocoPhillips, Occidental, and CNOOC. Interestingly, Sinopec and PetroChina have actually, their share price actually increased marginally in the last 12 months. I also know that a lot of these majors, they are quite vertically integrated, so they also have their middle and downstream where they refine and distribute their products. So this actually helps to buffer some of their upstream oil production operations. Okay, so okay, we are open for questions today. Thank you. Hi, so we have a question from the audience to comment on oil-related ETFs. Okay, so oil-related ETFs, the one of the structure that you have to understand is that typically they have to roll over their positions. So may I just reverse back to the contango trade? Okay, so the thing is that a lot of ETFs, they have to roll over their oil trade positions. So that means that let's say if today the oil price is priced at $47.72 for February delivery, and it's about to expire, you have to roll over to March. You might have to roll over at say $48, $49 per barrel. So this does eat away some of the returns, as well as a lot of ETFs. If they are physical storage, they also have to pay the insurance and storage costs. So this also eat into some of the returns as well. Okay, and now I want to ask, what's the outlook on oil price? Okay, so based on the facts that we have discussed just now, in the near term might not look so good. Okay, but we are trying to refrain from giving an outlook because we believe futures they have their own opinions. So and also today we issue a TA report, so you can actually refer to it to see where the oil price direction will be going in the near term.
Hi, Benjamin here speaking. I have a question here on for Keppel Corp, what's the price to enter and how far you will drop with the current oil price drop. So for Keppel, we don't for the entry price, the technical call, we don't have a technical rating on Keppel in terms of entry and exit price, but based on fundamental wise, current oil price does not sustain, it's not economically viable, as Yongkai mentioned, to drill in deep water wells. So we can, assuming that the next year going for 2015, there are no order wins for any deep water types of oil rigs, as well as 1 to 2 jackups for this year, and 1B of production related asset wins. Right, that should bring us to a valuation about $8.20 with a peg to a 10 times PE. So that's our base valuation for Keppel currently. Alright, in terms of entry price, we do not have a rating on that. Thank you.
Hi, Kenneth here. Okay, so there's a question is, there's one on oil ETFs, what to look at. Well, I'll just mention a few. The very common ones would be the USO and the USL. These are the single leverage futures-based ETFs. The USL is supposed to, okay, USO is the most popular one, but the USL suffers from, I would say, slightly less contango effects because the futures that they hold is stretched between for the whole year, as in they own short-term as well as long-term futures. So if there is a contango effect, it's usually more diluted as opposed to the USO. But if you look at the correlations between the USO and USL and actual crude oil price, you see that it's very well correlated. So these are the single leverage ones. For more short-term ones, but you want a higher leverage, there is the UCO. Okay, that's a triple leverage ETF. But at the same time, this one does suffer from some decay. So you really wouldn't want to hold on to this for a very long period of time. So if you want to hold on to ETF for a longer period of time, I suggest the USL. Okay. Another proxy to oil is that you can actually can consider buying the XLE, which is the energy sector spider. So this is just the ETF that holds a wide range of essentially all companies, and the top 5 holdings of the XLE is actually all majors like ExxonMobil. Can't remember the exact 5, but the top one is ExxonMobil, and number 5 is Schlumberger. So that would be a more broad-based way of spreading your risk out if you want to buy into companies lah.
Hi, so we have a question about which industries will most likely benefit from the oil price decline. Okay, often you'll be more aware of will be like say the transport stocks, like say airlines, trucking, as well as also those some chemical manufacturers where a lot of the petrochemical feedstock are the raw materials. Okay, but that being said, right, you have to understand that a lot of them actually hedge their costs, so their cost basis is still quite high. You have to oil prices will be sustainably low for another maybe say 6 months or so before they will be able to capture and lock in these prices favorably when they hedge it. Yeah. Hi, yes, so we have a few questions regarding the direction of the oil price in the short term. Okay, again, our team actually published a TA oil price report just this morning, so we just encourage you to refer to it. Thank you. Hi, this is one of the last questions we have for today. Okay, the output from Russia shown on the chart is it pure oil or input gas? This is purely oil. In fact, actually, this crude oil, right, actually includes, okay, this chart includes crude oil as well as natural gas liquids. Thank you. Oh, okay. Here's the last reply. Where to download the TA report published this morning. Okay, you can either get it from your Remiser, or you can just go to the Podium's platform under Research Reports, then you'll be able to see it. Thank you. Alright, that's all we have for you today. Thanks for tuning in to today's presentation. Okay, if you have any other questions, we'll try to help assist you. You can just direct it to us. If not, we'll just see you next Monday. Alright, okay. Thanks a lot. Have a good day. Bye.